So hopefully everyone can see our opening slide. Keith, can you confirm that that is there?
Yeah, that's on. That's clear.
Right, very good. I'll kick off then. So hello everyone and welcome to Foulger Underwood's latest accounting M&A market update. And my name is Kevin Reed. Over the next 40 minutes or so, I'll be asking questions of Foulger Underwood MD Keith Underwood. Keith, give us the customary wave.
Hello. Good afternoon to you all.
Or it could be good morning or good evening if you're watching it archived on YouTube later on. And so today's questions are going to revolve around the M&A market for the accountancy sector in the UK, and our topics should be on your screen. We're going to talk about the latest deals. There's a few to cover. Maybe not as many as our last session, but Keith will give us more detail on that. We'll also look at what the independent firms have been up to. Then it's those cheeky flippers, the timing and the implications of some of the PE flips of recent weeks will again be expanded upon by Keith. And last but not least, we will cover practice valuations and how that is moving. I think that has moved over the last probably 12 to 18 months. But again, Keith will give us a little bit more detail on that. So I'll stop our share screen for the moment. I'll just run through some quick housekeeping. And for those of you who don't know, Foulger Underwood is a leading advisor to professional services firms, helping with M&A advice through to succession planning, strategy, and leadership development, among other things. And you can visit foulgerunderwood.com to find out more. Last point is we will take questions, and of course, we welcome them. We usually have quite a few questions during our sessions, so feel free to use the Q&A button to send them in, and we will either broach them as they arrive if they fit the flow of conversation, or I'll keep them for the end of the session. If you have any questions that I guess that you deem sensitive or you just like to have a chat with us, then feel free to drop Keith a line at keith@foulgerunderwood.com. And if you're watching the recording of this, then drop a comment in YouTube, or again, just drop Keith an email. Today's session will be 40 to 45 minutes or so. I shall share screen again. So there's our kind of intro screen, or content screen. Hopefully if I click, it should take us to our first slide proper. So Keith, I'm handing over to you.
Thanks very much, Kevin. And good to see so many people attending this update. It seems to be growing from strength to strength. So at least if you're not directly involved in being acquired, certainly there's more inquiries about what's going on in the marketplace and to catch up with some of the deals which have been progressing in the last 3 or 4 months. We run these every 4 months, I think now. So most of what we're talking about in terms of practice deals on this first slide are basically through the relatively quiet period of December and January, but certainly deals have gone through. The activity, I feel, has most likely slowed a little. It might be to do with the year, but it might be also to do with the fact that we're now well through 2 or 3 years of consolidation. A number of firms have obviously gone and sold, and a number have decided to remain independent. And although there are some larger firms which have gone to the consolidators in the last 3 or 4 months, the actual marketplace is tightening. And I think you'll see that during this presentation. We will have some comments on that and the effects on pricing that are coming through into the marketplace at the moment. So
Has
moving,
CGT had an effect, Keith?
strangely enough, anecdotally, people are saying there should be a surge, but to be honest, no. We're acting for 2 or 3 clients who felt that they wanted to get out by March, but are not too worried about it going on into the second quarter into June. No, I don't think there's been a great surge there. But of course, this is CGT's in 2 bites, isn't it? You've got an increase in April, and then you've got a subsequent increase of a further percentage point. And you might see the flow continuing slightly above average for particularly the smaller firms. I don't think it's really affecting the larger firms in terms of those coming to the market for merger or sale. So the activity seems to have slowed, as I say. I've split these into two, the consolidators and the independents, and there's a marked difference in the activity level for both those two groups. When we look at the consolidators, we're looking really at pipeline feedback, which the management teams are saying is quite good, but one believes that perhaps the pipeline is getting a little thin, or they're having to increase price to attract people through the door and to get to meetings. I suppose the big news of this quarter is Grant Thornton, which, following the US end of Grant Thornton going to private equity, strangely enough, the UK end has taken on investment and private equity, but from a different PE house, which of course raises some questions, and we haven't really covered that with them as to what that does for the international branding if you have two different owners and possibly two different strategies they're going to pursue in terms of acquisition and roll-up. But of course, that's for the future. But Grant Thornton, one of the big 10, has taken on private equity. And as I say, their strategy is somewhat different between the US and UK marketplace. So the consolidators in the UK, pipelines, as I say, the feedback is strong. However, a lot of the emails and discussions going on are not necessarily going to come to full fruition. I've had two meetings in the last fortnight where people have received LOIs from different consolidators, which are still on their desks. They have no intention of actually furthering the discussions. So apart from the initial discussions, exchange of data under confidentiality, the actual targets are not interested in progressing these. And I think this is going to be another result, I suppose, of the intense activity with the M&A sides of these consolidators who are sending out emails on a daily basis to most of the independent firms throughout the country, certainly above a million in turnover.
I mean, Keith, would that not
Turnover.
give some firms the feeling that if there's so much interest, I mean, I guess you can take it both ways. You can either say, right, we need to grab this with both hands now, or you say, there's so much interest, we're going to hold out and get to a point where perhaps valuations go up because there aren't as many opportunities in that pipeline.
Yeah, I think we'll cover that later on, Kevin. The observation is absolutely right. And the short answer is yes, prices are going up.
Yeah,
And
let's not use all of our valuable material.
no, let's not use it all in the first 5 minutes. But anyway,
One
uh,
more question.
yep,
LOI, letters of interest?
letters of intent, which is in
Intent.
fact the offer from the acquiring party, um, draft heads of agreement, if you like, covering the deal structure and the deal financials.
Okay.
So I think the consolidators are certainly very active. We've still got a few in the marketplace. Some of the deals that have gone through are interesting in the last 3 months, 4 months. You've got Gravitar, who had been extremely quiet, taking over Critchley's and a couple of West Country practices. Shaw Gibbs took over Langdowns, which is quite a big operation down in the Solent. And they'd obviously previously taken over Martins in Winchester, which are quite local to each other, those two firms, which is sort of in giving them a very strong base in the Solent for future expansion westward, or indeed along the south coast. You've got Zenadin acquiring smaller firms still, Mudd and Co out in Essex, and Devonport's LAS. Still continuing to make those acquisitions. TC Group, largest one I think we picked up there was UHY Letchworth, they've picked up, and another number of smaller infills. Now, TC Group is strangely, not strange, with 49% left with the ongoing partners, they have recently looked at fill-ins, as I call them, or bolt-ons, that their existing operations, their existing investments will make 100% acquisitions in smaller practices of perhaps 1.5 million or below. And they're willing to make 100% acquisitions of those businesses. And that's a pretty active market, which drags them down into a sector of the market which had previously remained unattractive to most of the consolidators. Sovereign, which is the private equity house, changed their name from LB to Athenia, and they announced 2 or 3 acquisitions, including GWC and Clarkson Hyde. Beavis Morgan, good firm, Central London, have gone in with Kinbook Group, which is backed by Blixt, which is equally financing the Duncan and Topless roll-up, which is actually seems to be a two-pronged move into the marketplace for Blixt.
So that's Blixt having 2 separate brands.
Correct, which is the same really as Tenzing as well, which they've got 2 separate brands as well, Gravita and the one in the Midlands. So yes, there are different things going on with different private equity houses. Danes acquired a good Scottish firm, Concilium, in this last 3 months. I suppose more importantly, assets, looking at the Swedish business of KPMG, means they're raising their horizon and their activities well beyond the UK marketplace as such, they've been in Scandinavia before, but that was a fairly big one to look at KPMG's Swedish business. Interestingly enough, and just from our own experience, we've seen a Hong Kong top 10 firm go in exactly the same way, where a private equity house took out the RSM business in Hong Kong, left the audit, but took out the rest of its activities for part of their consolidation. So some of these independently owned larger names are certainly in the sights of the consolidators worldwide, to be honest.
And that puts the networks under some pressure as well. Of course, all mergers and acquisitions do.
Well, we covered that in the last presentation, yes, and the networks and alliances, I think, have a number of questions about their strategy for the future and where they're going to be in the future as the consolidators roll through and pick up some of the larger practices which are members of those alliances and networks. So yes, that's a good point. But I think we covered a lot of that last time in the presentation in November. I think looking at this list of acquisitions with the consolidators, it's clear that people like Critchley's going 10 million plus, 10 to 20 million, Shipley's going within this quarter, does indicate that some of the larger firms who have stayed out for 2 years have reconsidered their position and been encouraged to throw their lot in with the consolidators. And there will be a few more of these as we go through this current year. We're aware of 2 or 3 which are in discussion, and whether that is a strategic move by those larger practices to give up their independence and go with the consolidator because they feel this is the top of the market, or whether they feel they had other pressures coming on board in terms of retirements, which led them to the conclusion that without succession, they would have to look at a consolidator buying them out. I mean, so that's open at the moment, but it's an aspect where you've still got some chunky ones going through the consolidators, and of course others remaining independent. So the list of acquisitions on the independents, we only actually picked up about 6 of these. One of them was the active people were Armstrong, Watson, Streets, and a couple of other smaller firms, which are actually buying these acquisitions out of their own funds or out of debt, which is fair enough. But the numbers, certainly that is the smallest number of independent acquisitions that we've seen in, I say, the last year of giving these presentations and tracking the acquisitions. So I think the independents, interestingly, have taken a slightly different view to this. They're not really competitive in the marketplace when it comes to a particular target as against the money that the consolidators can throw against it. So there is a move towards mergers of like-minded businesses, and this goes right the way down to maybe the 2 million plus level, right the way up to the 60 millions, where they are looking at mergers, and more importantly, they're looking to fulfill or broaden their service offering through talent recruitment. And that market for talent recruitment, which is partly generated by the consolidators and fallout from the consolidators, has actually been quite a useful area to develop new service lines and new revenue streams for the independents. And that is a continuing prospect for the future.
And so,
So that's really where we.
would you say, sorry to interrupt you, Keith, in that model or in the current phase of this model, does that mean that those kind of discrete individual appointments, I mean, they create there's a lot of focus to get good people in as it is, as opposed to spending that time thinking about merging. You almost can't do both, I would suggest in some circumstances. So it looks as if there's kind of more of a focus on talent, would you say then at the moment?
No, I think it's both, because they're addressing two different issues, one of which is scale, and one of which is the breadth of their service offering. So, you've got people out there looking for corporate services teams, you've got people out there looking for tax teams. So I wouldn't say they are one and the same strategies, if you like, by these independents. They are servicing two different needs. So if
Okay,
we go on
very
to the
good.
next, if we go on to the next slide, Kevin.
But just so you know, Keith, we're running at about 20, nearly 20 minutes in, so
Okay.
we're about halfway through our time.
So putting that aside, we've then changed our approach and looked at the activities of the independent practices at the moment. And as I said before, they are concentrating on mergers, talent and teams, and they're making good, really, of the fallout from the consolidators. So I think in terms of our consultancy side, and I don't think we're any different from any other advisory business in this sector at the moment, we have got maybe 10 times as many practices wanting to develop in the independent direction and looking for advice and looking for direction, which we're actually delivering through our consultancy side. So it's most likely 10 times more than there was possibly at the end of just before COVID in that sector, or just after COVID, 2021, 22, 23. We're seeing many more people who are actively looking at their strategy and taking action on that strategy, which may have been lip service previously. They're actually looking at forward plans and trying to develop something tangible, both to create, I suppose, scale and the spread of service lines so they remain competitive for their client servicing. So, I mean, see, what we're offering is a practice MOT type thing, status review, whatever you like to call it. That usually involves a initial discussion over the phone, followed by partners meetings, and then involvement in the strategy review and development of the forward plans, which often includes transactions, acquisitions, mergers, and of course might be something which we have with a number of practices where they're looking to grow for the next 2 or 3 years and then consider the consolidator offer at that stage with enhanced profitability and further growth under their belt. So that is a very active area for us at the moment. What is focusing our attention and indeed our clients' attention is, of course, the model of custodianship and recognition of goodwill. And this is in some cases a transitional matter where a few practices are now moving to the custodian model because they find that with the succession they have in place, it's either inaffordable to buy out the exiting partners or retiring partners, or they have issues of actually very few, they don't have the right people in the right positions for succession, and therefore that has to be sorted out within a sort of 2 or 3 year time frame if they want to remain independent. But where we're coming from there is succession, the talent that's on board, how that can be developed to run the company in the future, the remuneration models, which is to ensure that perhaps some of these profitable businesses, practices, where the partners have reduced in numbers in terms of equity partners, and they're taking home significant annual profit shares of possibly anything above 400,000, in some cases 700,000, which are basically, let's face it, are equal to some of the remuneration packages within the top four. And then you've got the funding of that. If somebody is going to take over the business on a succession basis, how are they going to fund even the capital account requirements of that business, the ongoing growth, and then on top of that, the payout of exiting partners? I would say we've got 6 to 10 assignments going in that area at the moment. And I would say 4 to 5 of those will most likely end up with a custodian model and a transitional arrangement to satisfy the exiting partners, who will have to either take a cut in their takeout for the goodwill payment, or they will in fact have to extend the goodwill payment they're going to receive over a longer period.
Keith,
So yeah, there's quite a bit going on in that area.
could you very, very briefly, Keith, because obviously we recently ran an independent practice webinar. I'll actually put the link in the chat in a moment or so. But is there if you were to, an elevator pitch for custodianship versus goodwill, and why custodianship seems a more sustainable model, what would your argument be, or your point be?
I think the point is that if you're recognizing goodwill in any significant amount for exiting partners, there is always a situation where the younger partners who are coming through or taking up partnership are going to have suppressed profit shares for a number of years while the exiting partners are paid off. We've seen some situations where agreements have been reached, maybe for payments over 10 years, maybe even longer. Annuities for life as well, we've come across, which we've had to unwind and monetize some element of that goodwill payment in order to make it a certain figure rather than extended for the life of the individual exiting. And in some cases, money going to their wives as well for the length of their lives. So
There is also the idea that you earn while you work, and while you're keeping the firm profitable. When you move from the firm, you take your capital out, but you don't take any more than that, and a new set of capital comes in. And I guess goodwill, it just disrupts the actual, as you say, the sustainability of a practice.
yes, it disrupts the remuneration of the ongoing partners, the sustainability of the practice. While you're paying out the exiting partners, it's quite difficult to go into a merger situation because there's a legacy commitment there, which has got to be funded by the younger partners. So it has a number of implications which are all undesirable in the current marketplace and won't actually change, I don't think, for the next few years. So I think the custodianship, as you say, Kevin, is you take out what you earn in the year in which you earn it. There's nothing at the end, but you do get your capital amount back.
I
And there are
think.
variations on this, obviously.
Yeah, it's a fascinating topic. I've put the link in the chat, so please open that in another browser and save that for a rainy day, which it is today actually. But please, yeah, stick with us through the rest of today's session before you watch our independent practice webinar. But it's all fascinating stuff. Keith, we're at 25 minutes in. Shall we move on to the next slide?
Yeah, I think we move on to the next go back onto the private equity situation. So what we've been seeing in the last 6 months is Assets did a flip, I think about a year ago now. I might be wrong. It might be 15 months ago, which was really obviously the leader in that consolidation market. HG Capital sold off 50% of their investment to another PE house. But what we're seeing now is the people who entered the market perhaps just before COVID or just after COVID, now going through a flipping process. And it's interesting that some of these were originally looking to hold their investments for what we were saying was 5 or 6 years. They're actually looking more in the line of 3, 4, and 5, and bringing forward their sale. Now, these are termed first movers in the marketplace because Assets was quite large. It obviously needed a significant investment by a PE house to take out even the 50%. Some of the others are a little bit smaller that are flipping now. And I would see we've got 20 consolidators or 20 or so consolidators in the marketplace. I think 4 have now gone and done their first flip. I think we're looking at another 3, possibly in the current year, who will be looking to flip the investment. This is PE house to PE house. There may be an IPO out there, and I think that's up in the air at the moment, but there might be an IPO out there taking the investment to a quote in the marketplace. But of course, there is a little bit of resistance there in the marketplace because the history with Numerica, Vantis, and Tenon back in the early 2000s has not been forgotten. There have been 2 legal firms who've gone public on the marketplace who have basically failed over a 4 or 5 year period. And some of the PEs, some of the liquid position in the marketplace, the market liquidity, if you like, for the sale of those shares when they go public is very limited. And you see this to an extent with people like Gately, who are still on there, and a couple of others on the legal side who are still quoted and in the marketplace, but their PEs are not, significantly over 20 times, which people had been hoping would rise a bit higher than that for professional service firms. So I think there might be one IPO this year or towards the end of this year. But generally speaking, we're looking clearly at some flips. Danes and Cooper Parry are the 2 most recent ones. We think they went, as we'll say in the next slide, at a reasonable multiple for the PE house, maybe higher than expected. And the effect of those flips, we've most likely got on the next slide, Kevin.
Yeah, we'll move on.
And this is a bar chart we've shown before, which basically shows the consolidator life cycle, the year 3 to 4 being consolidated a little as the first movers bring forward their sale. And I suppose the question is, why do these PE houses bring forward the sale? Is it that with maybe 14 of them in the marketplace who will want to flip over the next 2 or 3 years, is it a case that they're uncertain about the value they're going to get and want to be out first? Are they uncertain about the other PE houses and whether the PE houses have the enthusiasm for this sector that perhaps the initial PE house had when they made their original investment? Or are there other reasons? Well, the other reasons, of course, if you look at a PE house, are that they wish to monetize their uplift and their arbitrage, if you like, between what they've paid for businesses and what they have sold, what they can sell them at, as soon as possible. They are looking to return money to their investors in a particular fund. And it does depend upon the cycle of realizations within that fund. So a fund within a PE house will have multiple investments, and they will look to realize those investments over a planned period, maybe one a year, whatever cycle they wish to adopt, so that their investors are kept interested, their investors are kept rewarded. And the only way they can do that is by realizing their investments and taking off the table the fact that they have got an average PE that they've paid for accounting firms of perhaps 7 or 8, 6, 7 or 8, and they can sell to another PE house at 12 to 14 times. And that's the differential they have to report back to their investors. So there is a fundamental underlying drive to actually bring forward the realizations and the flipping of investments by PE houses. But there might be some inherent situations in there where they feel that with so many in a limited marketplace with so many players, that the first movers are going to perhaps be rewarded rather than perhaps competing in 18 months' time with 5 or 6 PE houses who want to sell their roll-ups to other PE houses down the line.
And so that
But,
in
yeah,
that flip year, the first flip year, or effectively year 5 in this, Keith,
yeah.
the new owner is going to want to push through, I guess, potentially a new round of integration, i.e., new deals or integration within what is there. Yet the EBITDA is still relatively high. Why is that the case?
Well, I put that in there to so you ask that sort of question, Kevin. You're absolutely right. The blue line shows the amount of money for new investments, which is really integrating new businesses in. And when the PE house buys out the originating PE house, the first investor PE house, when they buy those out, they will put more money on the table for future acquisitions. Remember, these PE houses are paying, as I've just said, between 12 and 15 times to make the investment. They have to dilute that investment down to maybe 8 or 9 by acquiring more accounting practices at perhaps around 5, 6 or 7 in order to dilute the cost of their investment that they're paying to the originating PE house now. So you're going to find more money put on the table and a greater activity level or a renewed activity level to bring on new acquisitions. And that is key for our marketplace, which if we feel has limited opportunities, the only way they can make those new investments are really by raising the price. And that will be an interesting situation over the next 12 months to see whether these new PE houses are going to raise the price that they're offering to the remaining independent practices to fulfill their growth potential and dilution effect. I think on the EBITDA side, you'll see that EBITDA increase goes up gradually from year 1 to year 4, but there are significant strategic moves, usually in year 3 and 4, which cuts out lower margin business from their acquisitions. The profit margins, they seek to increase those profit margins quite dramatically by increasing charge out rates. And we've seen that in a couple of cases. And there is obviously a flow on effect of that into flip year 1 and flip year 2 as those EBITDAs are pushed up. And that EBITDA has to be pushed up. The only way it can be pushed up is really through either additional acquisitions or reduction in cost. There is no other solution to the EBITDA going up.
So we have had a question in, Keith, which is kind of which is very linked to the points that you're making, which
Yeah.
is around do you feel that the consolidate, and bear in mind we have about 10 minutes left of our session, Keith, just so you know, have consolidators been successful at retaining partners post acquisition? Have they been able to kind of grow their client bases organically, as well as obviously through the acquisitions, i.e., have they actually kept the good running of the business there, keeping the right people, bringing clients in?
Yeah, it's a very interesting question. And we have asked a couple of the management teams and indeed the private equity houses whether they've got any data on this, which of course they do have,
but not publicly.
but they're not willing to divulge that. But it's a very pertinent question. I mean, say, do they erode the EBITDAs they've purchased and just cover it by additional acquisitions in terms of volume and scale, which one suspect is true? Are partners exiting? Yes, I think you saw the Cooper Parry one where some of the managing partners and senior partners who went with Cooper Parry on the initial investments in the first phase of acquisitions have in fact taken their what we call sweet capital in the top company, and they have monetized that and exited on the introduction of the new PE house at the higher value, at the 13, 14, 15 value that Cooper Parry attracted. So you have got people coming out because their sweet equity is being realized. You've got a continuous, I think, trend, particularly past the flip of the original acquired partners looking to exit. And obviously you've got to come back to this in that people consider the main reason for considering a private equity investor is in fact that you have succession situations you can't fulfill. So you've got partners exiting, you've got partners in the higher age group of 60 plus who are looking for exit, and perhaps the business can't afford to fund that with the younger partners coming through. So naturally you have a demographic which is likely to retire within 1, 2, 3, 4 years of the private equity investment coming in. So there's a natural trend there that partners will retire. Whether the question might be more relevant in terms of do the younger partners exit and seek to come back into traditional independent practices where their profits shares can be reinstated at perhaps 250, 300, 400,000 a year rather than what they have now taken as perhaps 120 or 150,000 a year with a consolidator model, because obviously they have sold that once. They have sold the differential between their basic salary and they've sold their super profit, if you like, to the consolidator. And the only way of getting that back, providing they don't have restrictive covenants, severe restrictive covenants, which most of the private equity deals have, they will have to come out and are able to join traditional practices which will offer higher profit shares.
But I mean, it does show you, Keith, that talent issues, succession issues don't go away because the firms are owned by PE.
No, I've in a couple of presentations I've made with PE people on the others, in the discussion, I've tended to say the PE houses are not worried if people exit, if they retire, because they have the feeling they can always fill the seat with somebody, and it is very much a push from below, with the second tier and third tier coming through and taking the place of the retiring partner. I
So,
think that's
Keith, I know we're kind of talking a little bit into our seventh slide here, but I'm just making the point that we're 40 minutes in,
yeah,
so
fine.
we should just keep wiggling on.
No, fair enough. So I think we go on to the next slide. I think that's a very valid question. I'm happy to take it up with somebody who asked it at a later date. But yes, there is post flip going down here. We're looking at around 12 to 15 times for a PE sale, which I've mentioned before in this presentation. There will be more money on the table. The only way to get the EBITDA up is through cost savings or acquisitions. Some members of the management team exiting or monetizing equity, it is going to take place anyway in the natural time limit of somebody wanting to retire. I think the models tested and growth left on the table for the next PE house, which comes back to that previous slide I had, in that if you're selling and we've been involved in Asia in a couple of these. If you're selling your PE investment, if the PE house is in selling an investment, they actually like to identify potential acquisitions for the next year. So the next PE house investing in this roll up actually has got some substance on which they can work to bring on some of those new acquisitions in the next year. So you always have to leave something on the table. And that could be part of the rationalization, which is not undertaken by the first PE house, but will have to be undertaken by the second PE house. And that could be a disruption to ongoing management. I would point that out. But generally speaking, it is a period of change. The new PE house can bring in a new strategy or a different emphasis to the strategy in terms of the acquisitions they're looking for, whether that's we're only interested in larger firms or we're only interested in smaller new acquisitions. But the driver is they have to dilute the price they've paid to the original PE house for this investment. Do you want to move on, Kevin?
Yes.
And I think the result of this, and I'll be very brief here, is there are reduced opportunities in the marketplace. And that will mean the multiples, which were 18 months ago, 5 to 7 times, now look to 7 to 10. And I've spoken to a couple of people in the last 2 weeks who are not necessarily considering an immediate sale and are actually talking to us about working on for the next 4 or 5 years. But they have been offered 9 to 10 times. Now they're very profitable and they are at the top end of the market in terms of attractiveness to a PE house. But it's interesting that they're going to that level, the PE houses, whereas previously they were talking about 7 or 8 as tops. So
Keith, can you clarify when you talk about attractive to PE houses, what size of firm are you talking about here? You're not talking about 200K in fees firms, are you?
no, you're talking about growth records, potential growth of the business, and the profitability of that business, and whether that profitability can be sustained.
So I mean, I don't know whether you talk about earnings multiples for the smaller firms as well, but generally it's discussed around fee multiples. So if you're looking at £500,000, £1 million firms, 250K fee revenue firms,
They're
uh,
still
what?
going, Kevin, very much at the, if you like, at the fee basis between perhaps 90p and 120, 1.2 times at the
And
small end. But there's still a very active market for that. We haven't covered that today, but there's still an incredibly active market at that level by larger firms of 2 million, 3 million, 4 million, etc. So that is where they lie. If you get to EBITDA multiples, of course, you still come back to a multiple of 1 being around a 4 times EBITDA multiple. So they do actually equate as you go up. So if you've got excessive profit, if you've got really strong profitability, that sort of equivalence tends to get distorted. But strong profitability that can be maintained and improved on with a good growth record is what I'm talking about when I'm saying a very attractive firm for the roll-up consolidators will
so as
attract.
you become larger scale, more sophisticated, better profits, that EBITDA model, a multiple does tick up.
It does tick up, yes.
Yeah.
And I suppose we've spoken to one in the last couple of weeks, a PE house who's not in the market yet. So they're looking at a 20 to 30 million pound foundation business, and they're willing to certainly go up to 8 or 9 times if it has the right management to form their part of their management team to take on additional acquisitions down the line. So there's a number of factors here,
Yeah. So
which
just very quickly, we are at 45 minutes. We did say we'd kind of be at around 45 minutes. If everyone wants to stick around for another 5 minutes or so, we can wrap things up. So please stick with us. And if you can't, obviously we will be sharing the video via YouTube, so you will have a link if you have to disappear. But if not, please stick around for a few more minutes.
So I think what I'd say in the practice valuations is very active at the lower end, and I know a number of the people registered today. It was a whole range of them, but the lower end is still very active. You can still get businesses away, as I say, at an EBITDA of 4, 5, exception is 6, and that's up to sort of 2 to 3 million. And that they might well be attractive and might well bring offers from the larger independents of sort of 20 to 60 million who are still in the marketplace looking to scale up their own operation as independents and are committed to remain independent for the foreseeable future. I think we also ought to say here that last point there, broader skills set acquisitions in some models. Danes have done particularly well in buying up a couple of practices which they're almost boutiques, they're specialist boutiques, which they then cross-sell in terms of services. So that might be an international VAT business, advisory business, something on the IT side, or indeed auditors of, a specialist auditor of public utilities and things like that in a very narrow range, which niche business, which is being brought in. That's not a very good example, the last one, but can be brought in and then cross-sell to broaden the skill sets that are being offered to the general practices they're acquiring. So there's a whole mishmash of models out there from these consolidators. I mean, it's fairly straightforward for the independents who have remained independent because you know what you're getting. You're getting a similar sort of ethos, most likely a similar sort of service delivery. And you can recognize as a smaller firm that that is how the services are going to continue and take care of your employees and your other stakeholders, including your clients. It's not so obvious with a consolidator acquisition, where, of course, with a flip every 3 or 4 years, the strategy might change and cause a little more disruption than would be the case with an independent. And I think that really brings us to the end. Very willing to take questions.
There is
If
one question. We'll run through it very quickly because I'm very wary of time. So we had a question at the start. It didn't really fit on into the flow, and if it did, I apologise. Is BADR available on the sale of a professional practice?
Sorry, I didn't quite catch that.
Is BADR available on the sale of a professional practice?
Um, what are we referring to there specifically?
I don't know. I assumed you would know. So, and you, yeah, it's one that's gone over our head. Maybe there was a reason I left that question to the end. Whatever BADR is, I apologise for our
Yes, I'm
ignorance,
sorry
quite
if we
frankly.
can't answer that one at the moment. Yes, but if you ask me,
Oh, of course, business asset disposal relief.
um, it's still available, absolutely, yes. Depending upon the deal structure that goes through. But yes, that relief is available as I understand it at the moment.
Yeah, someone said that it's at 14% from 6th of April or
Yeah, I think
new
that's still
tax
there.
year.
Then it goes up again, doesn't it? That's the point. It goes up again under the current regulations that are going through. And that is why I think we were talking about it earlier on. That relief's still available, but it is you actually have to get the deal through by the end of March, which gives you 1 month um, for the lift to 14%, and then it goes up, I think, to 18% a year later. So, it is we will see, I think, a trend of people aware that is, if you like, the relief is reducing. Um, So yeah, people might be planning exits on that basis, but we haven't seen a really strong flow of those at the moment coming to the marketplace.
Yep.
Certainly not in the sectors we deal with.
So that was our question. Thank you to all the lovely and helpful accountants that were able to answer our query there. I'd just like to say thank you very much. It's been an absolutely fascinating session. Keith, Brilliant stuff as ever.
Thank you very much, everyone, for joining in. And yes, we'll be running another one of these in 3 to 4 months' time, and we'll see where the market's going in that time frame.
Indeed. And Keith's details on screen. So please get in touch with him if you'd like to talk about your firm in its direction of travel. Keith at foulgerunderwood.com. I put a link to the independent practice webinar in the chat, so please have a look at that. Follow us on YouTube. We've got plenty of other videos. We post on LinkedIn. And yeah, thank you very much for joining. It's been a really, really interesting session, and hope you can all join us again very, very soon. Thank you very much.